All right. Welcome to Hungry for Moats. Today we will be discussing Warren Buffett's letter from the year 1966. And this is the letter for his partnerships, not the Berkshire Hathaway letters. Though, as we saw last year, he does mention what has been going on with the Berkshire Hathaway, kind of gives his overall view about that industry, what was going on through his mind when he bought it. Okay, let's just dive in. I'm sure he killed it again this year.
Yep.
First half. This is the first half of the letter for the 1966 year. Yep. During the first half of 1966, the Dow declined from 1969 to 969 to 870. One had owned the Dow during this period. Dividends of approximately $14.70 would have been received. So overall loss of about 8.7% in the first half of 1966 for the Dow index. It is my objective and my hope, but not my prediction, that we achieve over a long period of time an average yearly advantage of 10% over the Dow. During the first half, we did considerably better than expected with that overall gain of approximately 8.2%. So they gained 8.2 and the Dow went down 8.7.
Mm.
Such results should be regarded as highly abnormal. I have previously complimented partners on good nature tolerance they display in shrugging off such unexpected positive variances. The nature of our business is such that over the years we will not disappoint the many of you who must also desire a test of your capacity for tolerance of negative variances. This is such. I think he took like the Dale Carnegie course, so I think
Mm.
it's like there's so much uh, good rhetoric in all of this. I mean, it's all like, oh, we just compliment you. It's like it's just all positive vibes, right? It's like I just want to tell you how gracious I am that you are not getting carried away. All these positive results that we are having, that you're
Mm-hmm.
maintaining your composure. And the dude's like, "What do you mean? I'm super excited." But now he's setting that expectation
Right.
that, oh yeah, Buffet wants me to not be too crazy about this, so I will not be. But
Yeah.
it's like, I know you also want to know how well you can uh, what kind you want to test your steel, your nerves of steel, or getting downtimes. And I'm sorry to disappoint you that we have not had a downtime yet, but I'm sure in the future we will have a shitty time, so you get to experience what you're made of.
Yeah.
So I apologize for that.
I completely agree. I think whether it's his nature or whether it's the Dale Carnegie course, I feel like there's a lot of this. And also, what's interesting is that he makes you feel like you're the hero, but really,
Yeah,
you didn't
it's
do
just
anything.
it's
You didn't
like,
do
oh,
anything at
thank,
all.
thank you, Buffett,
I was
thank
like,
you.
yes, I did
Yeah,
hold composure. That's
yeah,
right.
that's right.
Oh,
Oh, pat
God.
me on the back. Why am I paying Buffett commission? I should be getting a commission.
Oh, God. Okay, let's see how they did.
The summary.
Oof.
Uh,
Oh, okay. Partnership 29, 23 for
I
the
mean, not much
shareholders,
change at this
9%.
point.
Okay.
It's ridiculously consistent, man.
Yeah.
I mean, oh, of course, doing like what 16% over what the Dow did, which is actually down.
Yeah.
Incredible, incredible. Mwah.
You know what's interesting? Can I just point out also
Yes,
in
please.
all the not so 1956, let's say, to 1966, in about a 10-year period, what's interesting is that compared to today's kind of climate, there were negative years. So if you look at the Dow in the or maybe just the S&P 500 because I'm more used to that, but if you look at it for the past I'd say 10 years, it's always just
Hmm.
been positive, 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 positive. You know, even with the lockdown situation, it's always just been positive. You know, you had small years of downturn maybe, but really most of this, if you were to look at maybe 2000 or 2010 to 2020, it would have been all positive years. We were very
You
much in a
said the
growth
index
period.
usually does positive, is what you're saying?
That's right. Yeah.
Yeah, yeah, and that's actually today for whoever's listening was the Munger's meeting from Daily Journal for 2022. And he's been mentioned that like when he graduated, like you could just go in the index and it was just incredible, mostly bull run. And he said again, pessimistic about that can continue for anybody graduated from college today and just wants to make money using the index.
Mm-hmm.
But that may just be Munger Buffett always saying the future is gonna be sad,
Mm-hmm.
like lower your expectations, but
Yep.
who knows?
Yep. Okay.
Okay, let's see. Even Samsung gets clipped occasionally. If you had invested $100 on January 1 equally among the world's largest auto company, General Motors, the world's largest oil company, Standard of New Jersey.
Interesting.
This is incredible after learning about Standard Oil.
Yeah.
The world's largest retailing company, Sears,
Which is
rest in
bankrupt now.
peace.
Rest in peace.
The world's largest chemical company, DuPont. I bet they're still in business.
DuPont's in business, yeah.
That's incredible. The
Yeah.
world's largest steel company, U.S. Steel. Don't know much about that. The world's largest stockholder-owned insurance company, Aetna. Is that the one CVS bought?
I've heard it, but I don't know where.
I think CVS bought Aetna or some insurance company.
Mm.
The world's largest public utility, AT&T, and the world's largest bank, Bank of America. Oh my God, everybody loves Bank of America.
Mm-hmm.
Still, I feel like Bank of America will never die,
Yeah.
ever.
Pretty great moat. Mm-hmm. Your total portfolio.
Your total portfolio, including dividend received, would have been worth, oh shit,
So I
83,000
think that
on
was
June 30th.
100,000 though. I don't think.
Yeah, it must have been 100,000. That's not a
No,
period, that's a
that's actually
comma.
maybe that's 100
No, it has to
total.
be. It has
Yeah,
to be
100,000. Yeah, that's right.
for a loss of 16%.
Yeah,
Yeah,
because it's been clipped. Okay, so you really
yeah.
okay, got it.
The total market value on January 1 of these eight giants was well over 100 billion.
Wow.
Wow. Every one of them was selling lower on June 30th. Damn. 100 billion? I guess that makes. I don't think they're collectively 100 billion today. Maybe they
No,
are.
no, no.
I mean, Bank of America is probably up there.
Yeah,
And then I don't know about US Steel. I mean, AT&T is probably. Wow. That's incredible.
yeah.
Capitalism is brutal. Investment companies, again, I'm not gonna read the whole thing, but let's just cover this. So he goes over. I mean, here's our cumulative, of the big mutual funds of the era, and the Dow, and then the limited partner on the very last.
Mm-hmm.
And here you have the column of how they did this year. Again, they all did. Lehman did better than the Dow. Dow is like minus 8.7. But there are always variations. I mean, Lehman did better here, did worse here, doesn't matter. Point is, they always do worse. Well, they, I guess, did a little bit better than the Dow here. They all did better than the Dow this year. Maybe luck. But then, of course, Buffett, not just Buffett. After Buffett takes his commission, he was a limited partner, still killed it.
Mm-hmm. Yeah.
Right.
And the cumulative clearly shows that no one
Yeah,
beat the Dow.
23%, where they're all getting 8 to 10%. Like, what do you, just buy it.
Yeah.
Proponents of institutional investing frequently cite its conservative nature. If conservative is interpreted to mean productive of results varying only slightly from average experience, I believe the characterization is proper. Sorry, I'm going to read that again. If conservative is interpreted to mean productive of results varying only slightly from average experience, I believe that makes sense. Such results are almost bound to flow from wide diversification among high-grade securities, since over a long period, average experience is likely to be good experience. There is nothing wrong with a typical investor utilizing this form of investment median. That makes sense.
Mm-hmm.
Conservative, you just want to track the Dow. Dow mostly does good, then bad, like you pointed out. And for average person, that's not a bad thing.
It's pretty
Dow is
good.
admirable.
Yeah.
However, I believe that conservatism is more properly interpreted to mean subject to substantially less temporary or permanent shrinkage in value than total experience. This simply has not been achieved. As a record of the four largest funds, presently managing over $5 billion, specifically Dow declined in 1957, 1960, 1962, and the first half of 1966. Accumulating the shrinkage in the Dow during the full year periods, producing a decline of 20%. Following a similar technique for the four largest funds, produces declines of 10, 20, 22, 24%, including the interim performance for the first half of 96 results in the decline in the Dow of 27.5%, and for the funds decline. Okay. Such funds, and I believe their results are quite typical of institutional experience in common stocks, seem to meet. Oops, what did I do? What did I do? Seems to meet the first definition of conservatism, but not the second one. So basically, again, just saying like they will track the Dow, but they do not meet the second definition, which is very important. According to Buffett, it should be subject to substantially less temporary or market shrinkage, subject to substantially less temporary or permanent shrinkage in value than total experience. So basically, a conservative portfolio will go down less than the index, and these do not, and Buffett's does. Most investors would climb a rung intellectually if they clearly delineated between the two interpretations of conservatism. The first might be better labeled conventionalism. What it really says is that when others are making money in general run of securities, so will we, and to about the same degree when they're losing money, we'll do it at about the same rate. This is not to be credited with when others are making money, we'll make as much, and when they are losing money, we will lose less. The second one is what Buffett wants. Very few investment program accomplish the latter. We certainly don't promise it, but we do intend to keep trying. I have always felt our objectives should be somewhat loftier than those Herman Hickman articulated during the desperate years when Yale was losing 8 games a season. Said Herman, I see my job as one of keeping the alumni sullen, but not mutinous. Hochschild, Cohn, and Cooperate.
Maybe this is one of his holdings. Interesting.
Yeah, let's see. During the first half, we and two 10% partners purchased all of the stock of Hochschild, Cohn and Company, a privately owned Baltimore department store. Interesting. This is the first time in the history of the partnership that an entire business has been purchased by negotiation. Although we have from time to time negotiated purchase of specific important blocks of marketable securities, however, no new principles are involved. The quantitative and qualitative aspects of the business are evaluated and weighted against price, both on an absolute basis and relative to the other investment opportunities. HK learned to call it that. I didn't find out how to pronounce it until the deal was calculated. Sexify in all aspects. We have top-notch people, both from a personal and business standpoint, handling the operation, despite the edge that my extensive 75 cents on an hour experience at the penny store in Omaha some years back gives us. I became an authority on the minimum wage act. They will continue to run the business as in the past. Even if the price has been cheaper, but the management has been run of the mill, we would not have bought the business.
So, quick question about this: do you think that this retail business is it related to the Berkshire partnership?
I don't know. He said like he bought it with we and the two 10% partners.
Okay.
So we implies partnership,
So,
not
yeah.
just Buffett. Otherwise, he wouldn't put it in the letter.
Yeah.
If it was just for a private deal.
But I wonder if that's like to support the Berkshire. He's maybe if we were to pierce inside what's going on in his head, he's like, look, there's this problem that I'm having with Berkshire. I need this retail company to help out that thing. Maybe that's the case. I don't know.
No. I don't
No?
think so. Because he didn't buy it for Berkshire. He didn't buy it under Berkshire. He's buying under the partnership.
But I mean, I think in his mind he's going to dissolve this partnership pretty soon and only focus
But
on
he doesn't
Berkshire.
know that yet. I don't think he wanted to. It's still early. I
Oh,
mean, he
okay,
does
okay,
it. Yeah, yeah, yeah.
okay.
So basically, he's saying he bought it because they had good management. He's like, even if the store was selling for less, but the management wasn't as good,
Mm-hmm.
he would not have bought it. So he really likes the management.
Okay.
Okay, it is impossible to avoid some public notice when a business with several thousand employees is acquired. However, it is important that you do not interfere the degree of financial importance to BPL from its news value to the public. We have something over 50 million invested primarily in marketable securities, of which only about 10% is represented by our net investment in HK. Wow, it's pretty big. You put
That's
5
huge.
million.
10%. Yeah.
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 We have an investment of over three times this much in a marketable security where our ownership will never come to public attention. Wow, he's saying this is not even our biggest bet.
Yeah. The
We have
biggest is
like three times as
30%, I
much.
guess.
Yeah,
Yeah.
yeah.
Mm.
This is not to say an HK is not important. A 10% holding definitely is. However, it is not as significant relative to our total operation as it would be easy to think. I still prefer the iceberg approach towards investment disclosures. Oh, he doesn't want to tell you everything.
Mm-hmm.
It is my intention to value HK at year-end at cost plus our share of retained earnings since purchase. This policy will be followed in future years unless there is a demonstrable change in our position relative to other department stores or in other objective standards of value. Naturally, we wouldn't have purchased HK unless we felt the price was quite attractive. Therefore, a valuation policy based upon cost may somewhat undervalue our holdings. Nevertheless, it seems the most objective figures to apply. All of our investments usually appear undervalued to me, otherwise we wouldn't have owned them. Market forecasting. Ground rule number 6 from our November package says, I'm not in the business of predicting general stock market or business fluctuations. If you think I can do this or think it is essential to investment program, you should not be in the partnership. Of course, this rule can be attacked as fuzzy, complex, ambiguous, vague, etc. Nevertheless, I think the point is well understood by the great majority of our partners. We don't buy or sell stocks based upon what other people think the stock market is going to do. I never have an opinion, but rather upon what we think the company is going to do. The course of the stock market will determine to a great degree when we will be right, but the accuracy of analysis of the company will largely determine whether we will be right. In other words, we tend to concentrate on what should happen and not when it should happen. In our department store business, I can say the considerable assurance that uh, December will be better than July. Notice how sophisticated I have already become about retailing. What really counts is whether December is better than last December by a margin greater than our competitors, and what we are doing to set the stage for future Decembers. However, in our partnership business, I not only can say whether December will be better than July, but I can even say that December won't produce a very large loss. It sometimes does. Our investments are simply not aware that it takes 365 and a half and a quarter days for the Earth to make around the sun. Even worse, they are not aware that your celestial orientation and that of the iris requires that I report to you upon the conclusion of each orbit. The Earth's not ours. Therefore, we have to use a standard other than the calendar to measure our progress. This yardstick is obviously the general expertise in securities as measured by the Dow. We have a strong feeling that this competitor will do quite decently over a period of years. Christmas will come even if it's in July. And if we keep beating our competitors, we will have to do something better than quite decently. It's something like a retailer measuring his sales gains and profit margins against Sears. Beat them every year, and somehow you'll see daylight. I resurrect this market guessing section only because After the Dow declined from 1995 at the peak in February to about 865 in May, I received a few calls from partners suggesting they thought stock were going a lot lower. Damn. This always is two questions in mind. If they knew in February the Dow was going to 865, and why didn't they let me in on it then? And if they didn't know what was going to happen during insuring 3 months back in February, how did they know in May? There is also a voice or two after any 100 point or so decline suggesting we sell or wait until the future is clear. Let me again suggest 2 points. The future has never been clear to me. Give us a call when the next few months are obvious to you, or for what matter, the next few hours. And no one ever seems to call after the market has gone up 100 points to focus my attention on how unclear everything is. Even though the view back in February doesn't look so clear in retrospect. If we start deciding based on guess or emotions whether we will or won't participate in a business where we should have a long run edge, we are in trouble. We will not sell our interest in businesses, stocks, when they are attractively priced just because some astrologer thinks the quotations may go lower, even though such forecasts are obviously going to be right some of the time. Similarly, we will not buy fully priced securities because experts think prices are going higher. Who would think of buying or selling a private business because of someone's guess on the stock market? The availability of a question for your business interest stock should always be an asset to be utilized if desired. If it gets silly enough in either direction, you take advantage of it. Its availability should never be turned into a liability, whether its periodic aberrations in turn formulate your judgment. A marvelous articulation of this idea is contained in Chapter 2, The Investor and Stock Market Fluctuation of Benjamin Graham's Intelligent Investor. In my opinion, this chapter has more investment importance than anything else that has been written. We will have a letter out about November 1 with a commitment letter, 1965, and estimated 1966 tax situation. Cordially, Warren Buffett.
Awesome.
That was pretty damn. He's just like, don't tell me, like, you better not tell me to sell or buy. I don't want to hear it.
Hmm.
I don't care the market's down. I still made money, so screw you people.
Yeah. But in every letter, he pretty much emphasizes the same thing. One is have a yardstick to compare yourself against, and then number
Yep.
two, don't look at these small little fluctuations. What we really should be judged is maybe in the long run how much returns we really get. You know.
Agreed, agreed, agreed. Um, this next one is about 7 pages long. We could try to do it. I guess
Yeah.
you're not gonna mind.
No, it's up to you. I'm down for either one.
Okay, how about you read it, and then I'll
Sure.
try to take over. Okay.
Okay. Sure. So
Wait,
this
is this
is
it? Yep, this is it.
okay.
The
This
second
is
half of 1966.
part two of 1966,
Mm-hmm, mm-hmm.
written in January 25th, 1967, the first decade. The partnership has its 10th anniversary during 1966. The celebration was appropriate. An all-time record, both past and future, was established for our performance margin relative to the Dow. Our advantage was 36 points, which resulted from a plus 20.4% from the partnership and a minus 15.6 for the Dow. Ouch. This pleasant, pleasant but not non-repeatable experience was partially due to a lackluster performance by the Dow. Virtually all investment managers outperformed during the year. The Dow is weighted by the dollar price of the 30 stocks involved. Several of the highest priced components, which hereby carry disproportionate weight, DuPont, General Motors, were particularly poor performers in 1966. This, coupled with the general aversion to conventional blue chips, caused the Dow to suffer relatively in general investment experience, particularly during the last quarter. The following summarizes the year-by-year performance of the Dow and the performance of the partnership before allocation. 1/4 of the excess over 6% to the general partners, and the result for limited partners. So you can see if we go down right to the bottom, about a 10-year span, cumulative results for compounded rate, Dow is about a 9.6. Buffett gets about 29%. The partners get about 23.5%.
But dude, this year is ridiculous. I mean, Dow is negative 15.
Yeah.
This is the most negative year for Dow till date during Buffett partnership.
That's right.
And he's like 20%.
I really kind of wonder what's going on here because it seems to be fluctuating so much, right? Like, how is it possible that 1961 the stock market was a 22% plus, and then all of a sudden 1962 it's negative 7.6, and then jumps again to 20.6? I mean, something is going. It's not as stable.
But also, like, this is not S&P 500. I mean, this is about big industrial
blue chip stocks,
right?
Sure.
And again, we're in the middle of a space race, a silicon race. So
Yeah.
I bet there's a lot of, TI, Intel. Those stocks are probably
Volatility.
booming, and
Yeah.
those are probably still going up. And these poor industrial blue chips probably aren't seeing, they're probably being sold.
Yeah.
And these investors that are still beating the Dow, maybe, they're kind of probably flirting with some of these growth futuristic stocks. IBM, I think IBM was really old though.
Yeah.
At least that's my theory without doing any research on the topic.
Yeah.
And cumulative
11.4% for the Dow. I think even if we compared the S&P 500 and included all those stocks, I think you'd get to around 11%. I doubt that it's any huge benefit. Yeah.
Say again?
I think you'll get to close to 11% as well if you were to compare the S&P 500 here.
Oh, okay. Probably.
Yeah.
I don't think they had the S&P index back then. But yeah.
Even then, if
the top 500 companies.
Yeah.
Sure.
Yeah. Partnership results: Buffett carried away 30% to the bank, and we, if we were limited partners, 23%, 24%. Interesting.
Yeah, I mean, look at this is like annualized, but like if you give him money, 10 years ago, he already 10x
tripled your money. Yeah.
1,000 times.
That's right.
He 10x'd it already. If you never give him anything else.
Yeah, that's right.
Well, maybe not. Not for you. For himself, yes.
Yes, about 7x, I guess, which is still nothing to choke at. Yeah.
Still, that's incredible, man.
Yeah.
No wonder he's rich. He kept taking all these cuts for free. From all these
for
people.
free. I feel like maybe the investors got it for free.
That's great.
Okay, investment companies. On the following page is the usual tabulation showing the results of the two largest open-ended investment companies, mutual funds. So again, he's comparing against the other guys in the room who are fund managers compared to himself. Again, killing it, 23.5% compared to around 9 to 10 at most, and 9.7 from the Dow. Okay, interesting. Again, don't expect this. This is not going to continue. All the Buffett disclaimers. Okay, these investment companies' performance figures have been regularly reported here to show that that now is no patsy as an investment standard. It should.
Dow. He probably means Dow.
Oh, okay.
That Dow is no
Dow.
patsy.
Yeah, I was wondering. It should again be emphasized that the companies were not selected on the basis of comparability to Buffett Partnership Limited. There are important differences, including one, investment companies operate under both internally and externally imposed restrictions on their investment investment actions that are not applicable to us. Two, investment companies diversify far more than we did, and in all probability, thereby have less chance for relatively bad performance relative to the now in a single year. And three, managers have considerably less incentive for abnormal performance and greater incentive for conventionality. It kind of makes sense. These guys are pretty much committees, while Buffett is pretty much an individual, and individuals, he thinks, if you're a fund manager, is better than a committee. However, the records above do reveal what well-regarded, high-paid, full-time professional investment managers have been able to accomplish while working with common stock. These managers have been favorites of American investors. More than 600,000 make free choices among many alternatives in the investment management field. It is probable that their results are typical of the overwhelming majority of professional investment managers. So kind of echoing what I just said. It's not true, however, that these are the best records achieved in the investment field. A few mutual funds and some private investment operations have compiled records vastly superior to the Dow, and in some cases substantially superior to Buffett Partnerships Limited. Their investment techniques are usually very dissimilar to ours and not within my capabilities. However, they're generally managed by very bright, motivated people, and it is only fair that I mention their existence of such superior results in the general discussion of the record of professional investment management. We should kind of take a second to talk about that, because he's saying, listen, I've been benchmarking against all these guys, but there's some other ones out there that have beaten my record. And he doesn't talk about consistency because over time I doubt that they've beaten his record, but I'm glad that he's acknowledging that.
I don't even know who else. Maybe some of the margin people. I don't know. Like his friends, like Bill Ruane or somebody like.
I think there was this whole class of people that came from the school of.
Oh, you think they're still all the value investor people
Absolutely.
that he's talking about.
Yeah, they've killed
What
it.
about Sequoia? Sequoia is probably in terms of an investment vehicle that was operational around this time.
Yeah, and they actually did really well. Like Bill, actually, I think in his later letters he might actually talk about Bill, since he started Sequoia and that whole management. But I really think there's this group of people, again going back to that letter, the Zoo of Dogville. I think there was a letter.
Oh yeah,
From Columbia. So there's a set of value investors that came from that class that did extremely well. So he's maybe talking about that. Maybe even Munger. I'm not sure.
yeah. Real estate.
Yeah. Or Munger actually opened up his own investment fund before he.
That's right. That's right. He was.
Yeah.
And low practice.
Yeah. Do you want to read this one?
All right. Trends in our business. A keen mind working diligently at interpreting the figures on page one could come to a lot of wrong conclusions. The results of the first 10 years have absolutely no chance of being duplicated or even remotely approximated during the next decade. They may well be achieved by some hungry 25-year-old working with 105,000 initial partnership capital and operating during a 10-year business and market environment which is frequently conducive to successful implementation of his investment philosophy. They will not be achieved by a better fed 36-year-old working with our $54 million current partnership capital who presently finds perhaps one-fifth to one-tenth as many really good ideas previously to implement his investment philosophy. Wow. I mean, it kind of made a point that if you have less money, you probably will do better.
Yeah, actually, maybe we should just pause on that because I have a question here. So, what do you consider as more money? I mean, when do you stop seeing the returns on your, I understand the concept of if you have more money, the returns will be lower,
Yeah,
but
you got
where's
more
that number?
problems.
Yeah, more money, more problems. Shout out Biggie Smalls. But what do you think? What's your thought on that? What is too much money?
I mean, really depends on what. I mean, if you're talking about stocks, right?
Hmm.
These, well, I don't want to say these days. I think Buffett still said around 2000 that if he had $1 million, he could still compound at 50%
Yeah.
a year.
Hmm.
If he had $1 million, that was around the dot-com boom.
Hmm.
So I think that, and this is 1960. So I mean, that's probably today. It's probably around like 5 million. If you have less than 5 million, you should be doing incredibly well. Is what I will say.
Okay, so pretty much shaming all of us right now.
Yeah, I mean we're doing negative 50%. So it's like we're doing worse than the index. So
Interesting. Okay, and I'd be really curious. I wish you would share the company's. so that we could try and find out or back calculate what the market caps of the investments that he's making. I would think that they'd be really small, maybe less than $1 billion market cap. Yep.
Yeah, and if I had to do his money is probably worth, I don't know, like 500 million in
Million.
today's dollars, at
Yeah.
least, if not $1 billion in today's dollars.
Yeah, but the whole investment strategy there was a little different, I guess, because Graham, after the shell shock of the whole that whole era, was looking for nets, and so maybe it'd be a different investment strategy, right? I mean, I wouldn't
Yeah,
say that it would be
possibly.
the same.
Yeah.
Yeah. Okay.
Buffett Associates Limited, predecessor to Buffett Partnership Limited, was founded on the West Banks of the Missouri, May 5th, 1956, by a hardy little band consisting of four family members, three close friends, and 105. Oh, that's where he got the money. $105,000. I tried to find some brilliant flash of insight regarding a future or present conditions from my first page in a half annual letter of January 1957 to insert as a quote here. However, someone evidently doctored my file copy so as to remove the preceptive remarks I must have made.
I don't know,
I don't know what
some
that is,
logistic
whatever.
thing. Yeah.
At that time, and for some years subsequently, there were a substantial number of securities selling at well below the value of to a private owner criterion we utilize for selection of general market investments. We also experienced a flow of workout opportunities where the percentages were very much to our liking. The problem was always which, not what. Accordingly, we were able to own 15 to 25 issues and be enthusiastic about the probabilities inherent in non-holdings. In the last few years, the situation has changed dramatically. We now find very few securities that are understandable to me, available in decent size, and which offer the expectations of investment performance, meaning our yardsticks of 10% point per annum superior to the Dow. In the last 3 years, we have come up with only two or three new ideas a year that have had such an expectancy of superior performance. Fortunately, in some cases, we have made the most of them. However, in earlier years, lesser effort produced literally dozens of comparable opportunities. Damn!
Mm.
It is difficult to be objective about the cause of such diminution of one's own productivity. Three factors that seem apparent are a somewhat changed market environment or increased size of substantially more competition. What?
Interesting. Wow.
So he felt it was harder to find things. This is 1967 or six, 1966, and he's already like
Mm.
give three reasons, and two of the reasons there's no control. The market changed. There's more competition, and his size increased. Well, we don't have the size problem, but what are we supposed to do with the other two problems?
Yeah, but
Markets.
even his size, maybe he answered that question that I had before of like how much money is too much. It seems like 500 million is where he's drawing the line, saying, "Hey, this is too
At
much
that
money."
time.
Yeah.
But also depends, where the market is, and I mean, he's trying to basically find companies around PE of 7 or less,
Mm-hmm.
and these aren't even growth companies, right? So he's trying
Mm-hmm.
to find companies that are selling for PE of 7 or less.
Mm-hmm.
Um, and he can't find that. Maybe his definition of cheap was like super cheap, and
Mm-hmm.
he's like, oh my god, that's why he was so certain.
Yeah.
It is obvious that a business based upon only a trickle of fine ideas has poorer prospects than one based upon a steady flow of such ideas. To date, the trickle has provided as much financial nourishment as the flow. This is true because there is only so much one can digest. $1 million ideas are of no great benefit to $1,000 bank accounts. This was impressed on me in my early days. And because a limited number of ideas causes one to utilize those available more intensely. The latter factor has definitely been operative with us in recent years. However, trickle has considerably more chance of drying up completely than a flow. So what is he saying? That now it's become a trickle and before it was a flow?
I think so because before he had less funds to work with, he was, I guess, more sure of the stock environment or maybe the marketplace in general. Um, but it seems as though, you know, it's easier for him to compound with smaller amounts of money, which we already knew. But I guess for some reason he's finding it harder to keep at that same rate. You know,
Because he's saying to date, the trickle has provided as much financial nourishment as the flow. So like the amount that like he doesn't
the
need
money he's
because he didn't
getting.
have the money, right? He didn't
Yeah,
have all the capital to take advantage of all these opportunities.
yeah.
So it didn't really matter that there were a lot of opportunities versus less opportunities.
Mm-hmm.
Because there's only so much one can digest with less money. But now that you're big, now you finally have money now, but you don't have the flow anymore. You drive to trickle.
Yeah.
Because I now have the money that I don't have ideas.
But you know what I don't understand is like, well, if he has a lot of money, then why is he not doing more controls? Because that means he could buy out companies outright and
But
just.
that's only if he can find it for a good price. He's not finding the prices he likes.
Mm, okay.
Okay, these conditions will not cause me to attempt investment decisions outside my sphere of understanding. I don't go for the if you can't lick 'em, join 'em philosophy. My own leaning is towards if you can join them, lick 'em. I don't get this.
I don't get it. It's an old saying, I guess.
We will not go into business where technology, which is way over my head, is crucial to the investment decision. Micron. I know about as much about semiconductors or indicative circuits as I do of the mating habits of the Shrash. That's my Polish Maybug students. If you have trouble pronouncing it, it rhymes with Shrash.
You
Yeah,
gotta
it's
love
funny.
these. Yeah.
Furthermore, we will not follow the frequently prevalent approach of investing in securities where an attempt to anticipate market action overrides business valuation, as so-called fashion investments has frequently produced very substantial and quick profits in recent years. And currently, as I write this in January, it represent investment technique whose soundness I can neither affirm nor deny. It does not completely satisfy my intellect or perhaps my prejudices, and most definitely does not fit my temperament. I will not invest my own money based upon such an approach. Hence, I will not certainly do so with your money. Finally, we will not seek out activity in investment operations, even if offering splendid profit expectations, where major human problems appear to have substantial chance of developing. What I do promise you as partners is that I will work hard to maintain the trickle of ideas and try to get the most of it that is possible. If it should drop completely, you will be informed honestly and promptly so that we may all take alternative
Alternative
action.
action. Ooh, this is interesting.
Announced in 96 results, our four main categories of investment worked out well in 1966. Specifically, we had a total overall gain of uh, eight, about $9 million derived as follows. That's a gain. This is gain
Yeah,
$9 million from $50 million. That's ridiculous. That's a 20% gain.
yeah,
Wow. Controls.
pretty great. Yeah,
Uh,
I wonder. A quick question before we go into controls and stuff. So I mean, am I right in thinking that all investment philosophy, I mean, all of Buffett's investments so far have to be categorized into these four things? So is that how he's looking at it? Where he's saying, hey, look, if I don't, my framework is I'm looking for these four types of businesses. Otherwise, it's too complicated. Whatever it is, I'm not going to invest in it.
no, I think those are the big buckets of what he thinks. I mean, a lot of them are interconnected. So the workouts are the separate one. Basically, to me, it's just two big buckets,
Hmm.
and he's combining into. So workouts will always be workouts. There's
Yeah,
really nothing. Workouts are temporary. He
spin-offs.
will even
Yeah.
buy money, borrow money. Dude, he
Hmm.
made a shit ton of money on workouts. He went from 7.6 million to 1.7. I mean, he made 1.7 million off of 7.6 million
Yeah.
off of workout, which are like guaranteed. That is incredible. I
Hmm.
mean, that is the power of spin-offs.
But the investment amount is actually relatively low compared to
Correct,
generals
but for
and
low
controls.
people like you and me, I mean, that's if you get that kind of results,
Yeah.
pretty much guaranteed. I mean,
Yeah. Yeah.
oh my God, people
Yeah.
will like run over to give you their money.
Yeah. Pretty incredible. Yeah. I
Then
guess
there's a
it's.
miscellaneous category that I guess they lost money, and I don't know what that is. Maybe that's yeah, I don't know. Maybe options. I don't know.
Yeah.
But controls are obviously things he bought and got control over, and I mean he made more money in workouts with
Yeah.
much less money.
Let's maybe talk about these two generals. Can you
So
remind
yeah,
me
so
what they are again?
generals. I mean generals are basically a general thing, right? What you're looking for, undervalued
Undervalued.
asset.
Mm-hmm.
And
But
private
yeah,
owner and
private owner.
relatively, I don't know if I fully understand. I don't know if he's talking about when he took a general that became a private owner or if he bought a general from a private owner. Because if he became the private owner, then that's a control situation.
Yeah, that's
But if
right.
he took a general, maybe he bought it from private owner, where he bought shares from a private owner. I am not sure, honestly.
Yeah,
I think
I
generals
remember
relatively.
there was a definition, but I think the generals I consider is just like maybe nets or whatever he was finding at the time, where it would be very uh, like just very valuable companies that
Correct,
haven't.
like
Yeah,
super
yeah,
cheap
super
stuff.
cheap companies. Yeah, which is the majority, as you can see. 22. But controls is also up there. So I wonder if the generals are so good but are so cheap that you would just want to buy them outright and then make them in control. Is that fair to say?
No, not all generals he wants to have control. He only some generals he wants to turn into controls.
Okay, but if you own enough of a general, doesn't that make it a control?
Yeah, but he never buy. He buys super slowly. So if a general remains cheap for like 3 years,
Mm-hmm.
then he may turn it into a control because he just buys so slowly over time.
Okay. Oh, interesting. So he dollar cost averages into an investment. He doesn't outright.
No, he just waits for he penny pinches.
Oh, okay.
Like if it's how to describe it. If like stock is 59 and goes to 63, he will not buy. He'll wait for it to go under 60 and then he'll buy it. It'll go up because he buys it, and these are illiquid stocks, right? These are not really um, big large cap stocks. So
Mm-hmm.
there's as soon as he buys a little bit, it goes up.
Mm-hmm.
So he has to continue to kind of go slowly, very
Mm-hmm.
slowly.
Mm-hmm. Okay. Yeah, overall
Uh,
gain 8.9 million. That's the conclusion here.
that is ridiculous.
Yeah, insane.
I mean, he has less general expense. I don't know what that is. Oh, this is his. Wow, this is how much he's burning through. $500,000 of expenses.
That's a lot of
Damn,
Pepsis.
that's
I
a
don't
lot
know
of.
what he's done. Yeah, interesting.
A few caveat before we get on to the main discussion. Explanation of the various categories listed above was made in a letter. If your memory needs refreshing and your favorite newsstands does not have the pocketbook edition, we'll be glad to give you a copy. The classification are ironclad. Nothing is changed retroactively, but the initial decision as to category is sometimes arbitrary. Percentage returns calculated on the average investment base by category should be understated relative to partnership percentage returns, which are calculated on the beginning investment base. In the above figures, security purchased by us at 100 on January 1st, which appreciated at an even rate of 150 on December 31st, would have an average investment of 125, producing a 40% result, contrast to 50% by the customary approach. In other words, the above figures use a monthly average of market values in calculating the average. Okay,
Mm.
you guys just started to say that. All results are based on 100% ownership, non-leveraged basis. Oh, non-leveraged. Even his workouts are non-leveraged.
What does that
Uh,
mean?
like he didn't borrow money to do them.
I see.
Interest and other general expenses are deducted from total performance and not segregated by category. Expenses directly related to specific investment operations, such as dividends paid on short stock, are deducted by category. When securities are bought directly and sold short, the net investment, longs minus shorts, he did shorting, is often for the applicable average investment category.
Yeah.
The okay, this is all kind of, I don't want to read all this.
Yeah. That's fine. Controls.
Controls. There were three main sources of gain during 1966 in respect to control companies. These arose through retained business earnings applicable to our holdings in 1966. So this is kind of Berkshire, and they had 100% control, so they got to keep all the earnings. Open market purchase of additional stock below our controlling interest valuation. Unrealized appreciation in marketable security held by the controlled companies. Okay, the total of a positive item came to about
2.6 million.
$2.6 million. So this is all about controls. However, due to the factors mentioned in my November 1, 96 letter, specific industry conditions, and other recent valuation items, this gain was reduced by about $1 million in arriving at our fair valuation applicable to controlling interest as of December 31st. Thus, the overall gain in the control category was reduced to 1.5 million for the year. We are undoubtedly unfortunate that we had a relative high percentage of net assets invested in businesses and not stocks during 1966. So he classifies businesses different than stocks. Businesses
Yeah.
are his controls, where he's like, we had a lot of these control situations and not stocks, because controls were very profitable for him. The same money in general market holdings would probably have produced a loss, perhaps substantial, during the year. This was not planned, and if the stock market had advanced substantially during the year, this category would have been an important drag on overall performance. The same situation would prevail during 1967.
That's interesting. This he got lucky is basically what he's saying.
No, he's like, he knows, right? This is his tool. I guess controls, these are not workouts, but these controls don't, they're private. They don't go with the market. They do what they will do. It's a business. So stock market can go up. That's not you have a, you know, it could be private business. It's not listed. It's like
Yeah.
buying a house. Just because stock market went up, your house value didn't go up.
Yeah. But I'm saying the amount of controls he had, if it was to be switched over to generals, then he would have done lower. So his stock
Yeah, because
picks.
stock market overall didn't go. Because generals have more swings with the stock market. Controls and workouts do not swing with the stock market.
Oh, really?
That's why
Is that a
that's why,
fact?
yeah, controls are more privatized, right? They're illiquid and they're not going to go up and down as much.
Oh, okay. Okay.
Because the bigger the company, the quicker they're going to go up and down.
Interesting. Okay. Maybe I can take over. You want me to read?
Sure, let's go.
Okay. General private owners. Our performance here falls in the $21 a day once a month category. In the middle of 1965, we started purchasing a very attractive, widely held security which was selling far below its value to a private owner. Our hope was that over a 2 or 3 year period, we could get $10 million or more invested in the favorable prices prevailing. The various businesses that the company operated were understandable, and we could check out competitive strengths and weaknesses thoroughly with competitors, the distributors, customers, suppliers, ex-employees, etc. Market conditions peculiar to the stock gave us hope that with patience we could buy substantial quantities of the stock market without disturbing the price. At yielded At
Year
year
end.
end 1965, we had invested $1.9 million, and the market value of our holdings was $2.4 million. So that 401,000 was contributed to performance luring 1965. We would have preferred, of course, to have seen the market below costs, since our interest was in additional buying, not in selling. This would have dampened Buffett Partnerships Limited in 1965 performance, and perhaps reduced the euphoria experienced by limited partners physically or psychically. The net result to all partners would have been a standoff, since the general partner would have been floating. Okay, kind of don't get that. But would have enhanced long-term performance. The fact that the stock had risen somewhat above our cost had already slowed down our buying program, and thereby reducing ultimate profit. An even more dramatic example of the conflict between short-term performance and the maximization of long-term results occurred in 1966. Another party, previously completely unknown to me, issued a tender offer which foreclosed opportunities for future advantageous buying. I made the decision that the wisest course it may not have been for us to follow was to dispose of our holdings, and we thus realized a total profit of $1.3 million in February, which was $868,000, was applicable to 1966.
So there, I guess a third party had sold the security he was buying,
yeah,
and he decided to also sell.
right, and I think I understand what this general, if I remember correctly, it's kind of coming back to me now. General's private is where you buy from a large holder who's willing to sell at that price that he's looking for. So from a private owner of that stock. That's how I understand it. But it's still a very cheap play and all that stuff that the generals that he looks for, you know. But that's how I understand it. He's actually getting it from a private person. So the reason why it kind of flashed in my mind is because he's saying here that someone else kind of came in and bought some of the shares, right? What was it? Where did I read that? Where he says, yeah, someone came in and someone issued a tender offer which foreclosed opportunities for future advantages buying. So someone else came in, paid for higher, and so they couldn't buy as much. So that's why he sold his position, and then made this 1.3%. But he's saying maybe that's not a wise decision, because he's saying that maybe if we held on to it for longer, we would have made maybe more in the future.
Yeah.
Yeah.
And I mean, so yeah, just giving to, I think somebody offered to buy it, so he sold it early. The second example, and then first example, but the stock got too hot, I guess, and he just couldn't buy
So he sold his position.
anymore. But did he sell? I guess he
Yeah,
sold,
yeah, he
but he
did.
just couldn't buy more. He wanted to buy more.
Yeah, so he disposed of our holdings, and we thus realized a total profit of 1.3%. I mean, 1.3 million. Yep. Interesting. Okay. While any gains looked particularly good in the stock and in the market environment that intimately developed in 1966, you can be sure I don't delight in going around making molehills out of mountains. The molehill, of course, was reflected in 1966 results. However, we have been much better off from a long-range standpoint if 1966 results had been 5 percentage points worse, and we were continuing to buy substantial quantities of the stock at the depressing prices that might have been experienced to prevail in this year's market environment. This is really valuable. The reason what I'm saying, like maybe we're kind of going through this. You know, Baba's seems like it's very cheap, and you know we're kind of crying here because it's going lower and lower. But in the future, we're hoping that our gains will be higher, right? So he's saying, you know, why did I sell instead I should have just bought more, because this year it would have increased, but last year it would have seemed like I did terrible. Or am I just saying that to justify
Yeah,
it
no,
to
I mean,
myself.
yeah,
Okay.
I mean, he's basically saying an ideal market, and I think it's more applicable to him because he's working with bigger and bigger sums of money.
Yep.
He's used to smaller stocks.
Yep.
That when he can't buy, when securities go up, it hurts him more because he likes the company, he likes the price, but he can't get in there
Yeah.
with all the money he wants.
Yep.
Like it takes him a long time, and then security moves up, and then now he doesn't know what to do because
Mm-hmm.
he can hold on to it, but it's like really not worth it. And then he has to still research a second company, and it's
Mm-hmm.
just annoying.
Mm-hmm. Yeah. Yeah. Agreed. Okay. Uh, so good ideas were dime a dozen. Am I there? Or
Yeah.
okay, good
Okay.
ideas were dime a dozen. Such a premature ending would not be unpleasant. There is something to be said, of course, for business operations where some of the failures produce moderate profits. However, you can see how hard it is to develop replacement ideas by examining our average investment in the private owner category. We come up with nothing during the remainder of the year despite lower stock prices, which should have been conducive to finding such opportunities. Interesting. Okay, generals. So this is the third category. Generals, relatively undervalued. Our relative performance in this category was the best we have ever had due to one holding, which was our largest investment at year end 1965 and also year end 1966. This investment has substantially outperformed the general market for us during 1964, 65, 66, and we have held it. While any single year's performance can be quite erratic, we think the probabilities of highly favorable for superior future performance over a 3 or 4 year period. The attractiveness and relative certainty of this particular security are what caused me to introduce ground rule number 7 in November 1965 to allow individual holdings of up to 40% and our net of our net assets. We spend considerable effort continuously evaluating every facet of the company and constantly testing our hypothesis that this security is superior to alternative investment choices. Such constant evaluation and comparison at shifting prices is absolutely essential to our investment operation. If it would be much more pleasant and indicate a much more favorable future to report that our earnings in the general's relatively undervalued category represents 15 securities in 10 industries, particularly all of which outperform the market. We simply don't have that many good ideas. As mentioned above, new ideas are continuously measured against present ideas and will not make shifts in the effect, and the effect is to downgrade expectable performance. The policy has resulted in limited activity in recent years when we have felt so strongly about the relative merits of our largest holding. Such a condition has meant that realized gains have been a much smaller portion of total performance than in earlier years where the flow of good ideas were more substantial. Okay. The sort of concentration we have in this category is bound to produce wide swings in short-term performance, some more certainly unpleasant. There have already been some of these applicable to shorter time spans than I used to use in reporting to partners. This is one reason I think frequently reporting to be foolish and potentially misleading in a long-term oriented business such as ours. Let me pause there and
Hmm.
see if I understood that correctly. So, is he saying generals are undervalued businesses, but then have larger swings compared to these holdings that he has for more concentrated or maybe controlled situations? So that's why even though we got the most benefit from these generals. First, he doesn't have as many ideas for the generals. Otherwise, he would have increased his portfolio there. And then second, um, um, you know, you need a more balanced situation where you have not as much volatility, more certainty, but you're going to get less benefit. And with generals, you probably get more swings, but maybe profitable and higher risk. Is that fair?
Yeah, I mean, yeah. Only caveat with general is it goes with the ups and downs of the stock market. Controls don't do that because they're very illiquid and you own majority of it, and workouts don't do that. So generals usually have more swings. That is a correct statement.
Okay, okay, okay. Um, okay.
But it looks like he
Anything
doesn't
else?
find enough idea where overall he hasn't made much money. I think he's
Right.
still looking for those big investments that he has high certainty and he can put a lot of money. Like I
Yeah.
don't think he wants to spend a lot of time on searching for a lot of small. I don't know if he wants to, but I think he's probably learning the benefit of concentrating and holding.
Mm-hmm. Mm-hmm. Yep. Okay, personally, within the limits expressed in last year's letter of diversification, I am willing to trade the pains, forget about the pleasures of substantial short-term variances in exchange for maximization of long-term performance. However, I am not willing to incur risk of substantial permanent capital loss in seeking to better long-term performance. That's a beautiful line right there. I'm not
Yeah.
willing to incur risk of substantial permanent loss of capital in seeking to better long-term performance. To be perfectly clear, under our policy of concentration of holdings, partners should be completely prepared for periods of substantial underperformance, far more likely in sharping rising markets, to offset the occasional overperformance such as we have experienced in 1965 and 1966. And as a price, we pray for hoped, we pray for
Pay.
hoped,
We pay for hoped
we pay
for.
for hoped for good long-term performance. All this talk about long pull has caused one partner to observe that even 5 minutes is a long time if one's head is being held underwater. Interesting. Okay. This is the reason, of course, that we use borrowed money very sparingly in our operation. Average bank borrowing during 1966 were well under 10% of average net worth. Okay. Yeah.
Oh, go ahead. You want me to read?
No, I can go ahead.
Okay, go ahead.
One final word about generals, relatively undervalued category. In this section, we also had an experience which helped result in 1966 but hurt our long-term prospects. We had just one really important new idea in this category in 1966. Our purchasing started in late spring but had only come to about $1.6 million. It would be bought steadily but at only a moderate pace. When outside conditions drove the stock price up to a point where it was not relatively attractive. Though our overall gain was $728,000 on an average holding period of 6.5 months in 1966, it would have been much more desirable had the stock done nothing for a long period of time while we accumulated a really substantial position. Okay, this is interesting. So what he's saying is really maybe wait for the right price, but double down on it and make a concentrated decision, even if it means short-term reward will not be there. Did I get that right?
Yep, yep.
Okay,
But
workouts.
same thing, right? Same thing about like we had to sell it, and the prices just keep going up, and he can't really get a big enough position that he wants.
Mm-hmm. Mm-hmm. Workouts. In in last year's letter, I forecasted reduced importance of workouts for workouts. Interesting. Okay, I don't remember that from the last year. Do you?
Yeah, I was just saying like there are just not many,
Opportunities, or is he?
yeah, opportunities, and workouts really help. So workouts are really helpful when you have not a lot of money.
Uh huh.
Most workouts help when you have working with little capital.
Mm-hmm.
And the point of workouts in his model was to provide stability,
Mm.
where most were in generals, and the portion was in workouts to guarantee at least some gains because they're predictable. He could borrow, make trades,
Mm-hmm.
and then that at least gives you, if the whole market goes and everything goes to, goes down, his workouts will be positive.
Mm.
But
Interesting.
now he can get that decoupling from the general stock market with controls because it's gone so big
Mm-hmm.
that he's moved from workouts into controls
Okay.
to
Okay.
to accomplish what workouts were doing for him.
Okay. Interesting. While they were not of the importance of some past years, I was pleasantly surprised by our experience in 1966, during which we kept an average of $7.6 million employed in this category. Furthermore, we tend to ascribe borrowings to the workout section so that our net equity capital employment was really something under the figure of our return was somewhat better than the 22.4% indicated on page 6. Here too we ran into substantial variation. At June 30th, our overall profit on this category was $16,000 on an investment of $7.8 million. So that we
That's
really
nothing.
had a case of an extraordinary good second half offsetting the poor first half. Yeah,
Yeah,
that's
really?
really
That's not a
nothing.
lot.
Yeah, no, that's just Buffett joking, I guess. 16,000, I don't know. Over a $7.8 million investment,
Yeah,
that's
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 nuts.
nothing. Yeah, at least it's a profit, you know.
Yeah.
In past years, something as much as 30 to 40% of our net worth has been invested in workouts, but it is highly unlikely that this condition will prevail in the future. Nevertheless, they may continue to produce some decent returns on the moderate amount of capital employed. So, this is interesting. So, does that mean that you shouldn't invest in workouts after you get to a certain capital amount?
Well, once you can find, because most spin-offs and mergers, I guess the assumption is happen in smaller, smaller companies maybe, or the arbitrage people play with isn't significant enough. I think the situation has changed. I think there's a lot. The capital markets are much bigger today, so you have big. There's really nothing small anymore. You have all these new companies don't even IPO till they're like multi-billion-dollar companies.
Mm-hmm.
The private equity business has become huge.
Mm-hmm.
So I think because of that, I don't think a lot of the rules that he finds work anymore. I think you can still do workouts today with large amount of monies, depending on the
But
situation.
is the reason because these workouts are smaller in capital, like as in you have this big company, let's say Hilton, and then they want to do a spin-off, and then which is the same thing as a workout. So then they deploy some capital, but it's going to be very low. So the returns that you would get on that are going to be um, maybe. I mean, it's high if you have small amounts of capital, but it's low if you have large amounts of capital. Is that true?
Yeah, probably, but I don't know. I mean, you may not have enough chances for the workouts because it may not be worth the hassle because the money you make probably is not that much, and your
Okay.
capital is drawn big. So you can, to get most out of your investments, you might as well go look
Somewhere else.
into getting controls.
Yep. Yep. Okay. Got it. Um, okay. Yeah. Okay. Miscellaneous. I don't know if we should go into it, but I don't mind reading it.
We don't have to. I mean,
Yeah.
it's
These
all gonna
are
be the
kind of small
same.
people. Blah blah blah
They have,
blah.
a lot of the investments are there.
Yeah.
They're aligned and tax and stuff. Insurance.
Great.
Okay, I think we
Yeah.
are done. So
Awesome.
I think majority difference here was he talked about his, what happens. These sometimes people perceive these short-term wins, but actually these are long-term losses.
Mm-hmm.
So I think that's a good takeaway from this lesson, and he
Yeah.
gives a lot of examples of that.
Yeah. Um, yeah. And I feel like moving forward, I almost feel as though Buffett is making too much money, so I don't know how applicable these lessons are. I mean, of course, the maybe life lessons and maybe capital allocation lessons might be important for us, but I feel as though he's not going to be talking about how to make small amounts of money grow. He's going to talk about how to make big money get even bigger. Do you get that feeling?
Yeah,
Yeah.
yeah. I mean, you gotta compound, and you gotta the more money you have, you gotta find things that are well suited for that.
Yeah. Yeah.
All
Awesome.
right.
Yeah.
Thank
Well,
you.
thank
That was
you.
beautiful.
Yeah, that was beautiful.